According to analysts, the fear gripping global markets right now is not about an imminent banking collapse. It is about what could happen if the small cracks we are seeing quietly widen beneath the surface. Over the past few days, reports of bad loans and hidden losses in the US have started to ripple through global markets. Two auto-related companies, Tricolor and First Brands, recently went bankrupt, and that collapse exposed a tangled web of complex debts held by banks and investment firms around the world. Jefferies reportedly had about $715 million tied up in First Brands, while UBS faced around $500 million in exposure. Not long after, Zions Bancorporation disclosed a $50 million loss on two commercial loans, and Western Alliance claimed a borrower had allegedly committed fraud. Those revelations spooked investors and sent bank stocks tumbling, first in the US, then across the Atlantic. By Friday morning, the Stoxx 600 Banks Index had fallen over 3%, dragging down nearly every major European index. Germany's DAX and Italy's FTSE/MIB both lost more than 2%, while the UK and France followed closely behind. According to market watchers, that sharp decline reflects a growing fear that the credit problems in the US could spread to Europe, especially as many global banks are tied together through shared lending markets. Former European Central Bank President Jean-Claude Trichet tried to calm nerves, saying there's no need to dramatize the situation, but warning that vigilance is essential. He pointed out that US policies on tariffs, spending, and immigration have created what he described as a kind of stagflation risk, slow growth, sticky inflation that markets have not fully digested yet. In other words, the danger isn't panic, it's complacency. Still, most experts believe the big banks are unlikely to fail. The giants, like UBS, Barclays, or Deutsche Bank, are far better capitalized and more tightly regulated than they were before the 2008 financial crisis. The real concern lies with the smaller and mid-sized lenders that dove into risky credit markets during the era of cheap money. With interest rates now high and economic growth slowing, some of those loans are starting to crack. For investors, it's a reminder that credit cycles have long memories. Markets can rise on optimism, but when debt goes bad, confidence erodes quickly. Analysts say that while this isn't 2008 all over again, it could be the early warning tremor of a deeper credit reckoning. As one strategist put it, it's not the quake, it's the rumble before it. If you like this kind of analysis, don't forget to hit follow, turn on notifications, and give it a thumbs up. It helps the channel grow and keeps you updated as the story develops.